afternoon. At the Central Bank of Nigeria Communique number 86 of the Monetary Policy Committee meeting of Monday and Tuesday, November 19th and 20th, 2012. The Monetary Policy Committee met on Monday 19th and Tuesday 20th November 2012, with 9 out of 12 members in attendance. The committee reviewed the domestic, global economic conditions and financial environment, as well as the challenges that face the Nigerian economy during the first 10 months of fiscal 2012, with a view to reassessing monetary policy options in the near to medium term. The international economic situation. The committee noted the continued deceleration in global output, which resulted from a combination of austerity-driven Eurozone developments, weak recovery in some Asian economies, and slowdown in major emerging market economies. In addition, high and rising unemployment, fragile financial conditions, weak housing markets, and deterioration in both public and private sector balance sheets in some major industrial countries pose major risks to global economic recovery. Thus, global output growth in 2012, which was earlier projected at 3.5% in July 2012 by the IMF, was revised downwards to 3.3% in the October 2012 World Economic Outlook. That of 2013 was also revised downwards from 3.9 to 3.6%. According to the October 2012 projection, there is a high probability of global growth falling below 2% in 2012, and this would mirror the recession in the advanced economies and the slowing output growth in key emerging markets and developing economies. Growth in the advanced economies is estimated at 1.3% in 2012 and 1.6% in 2013, reflecting a downward revision of 0.1 and 0.3 percentage points respectively. The US economy continued on the path of modest recovery as real output expanded by 2% in the third quarter of 2012 compared with 1.3% in the second quarter, reflecting the positive contributions from personal consumption expenditure, government spending, private inventory and residential housing investment in the face of current low mortgage rates. However, the recent Hurricane Sandy across the east coast of the United States constitutes an immediate risk to the sustainability of recent growth rally, and its impact is expected to truncate US recovery in the last quarter of 2012. Another major risk to the medium-term growth trajectory in the US is the fiscal cliff. The IMF has suggested a gradual resolution of the fiscal impasse in order to avoid the possibility of a sharp contraction. The Eurozone is officially in recession, in addition to the persistent uncertainty over agreements on a fiscal union, the start of European Central Bank's oversight of European banks, and the fragility of the Greek, Spanish, and other peripheral economies. Real GDP in the zone is projected to contract by 0.4% in 2012, with unemployment rising to 11.5%. The core economies in the zone are expected to experience low but positive growth during 2012-2013, while most economies in the periphery are expected to suffer sharp output contraction in 2012 because of tight fiscal policies and weak financial conditions. The German economy recorded slight recovery with unemployment falling to 6.5%, while the UK snapped out of a recession, recording a growth rate of 1% after 3 successive quarters of contraction. Rising uncertainty about the viability of the Eurozone and the possibility that the Euro area crisis will escalate remains a major downside risk to growth and financial sector stability. Overall, continued austerity measures in the Euro area are having negative spillover effects on the German economy, which is now wobbling on the verge of a recession due to widespread drop in aggregate demand. In emerging Asia, growth was estimated to have significantly weakened to less than 7% in the first half of 2012. Latest data indicate that growth in China slowed for the 7th consecutive quarter to 7.4% in Q3 2012, lower than the Q2 2012 figure of 7.6%. The People's Bank of China had already embarked on sequential monetary easing operations in order to loosen liquidity conditions and stimulate growth. This will, however, increase the risk of inflating real estate prices and a possible bubble with potential adverse impact on the Chinese financial system. In India, Output is expected to expand by 5.8% in 2012 as against 6.5% in 2011, with the slowdown resulting from waning business confidence, sluggish structural reforms, policy rate hikes designed to rein in inflation, and flagging external demand. In other parts of Asia, growth has dipped, hampered by the weak performance of the Chinese economy. Most countries continue to be affected by weak export growth, while the monetary authorities have responded with expansionary monetary policy. Output growth for 2012 at 5.1%, up from 3.3% in 2011 for the Middle East and North Africa region, could be considered robust in the face of global realities, but there's a sharp difference in growth performance between oil and non-oil exporting countries in the region. For the non-oil exporting economies, growth is projected to register just about 2% and 6.6% for the oil exporting economies. Economic activities in the non-oil exporting countries have remained suppressed by the growth deceleration in the major trading partner economies, internal conflicts, and pervading political and economic uncertainties. The robust growth projection for the oil exporting countries, on the other hand, is anchored on increased government expenditure supported by historically high oil prices. Despite these developments, the committee is of the view that growth of the MENA region in the medium term is faced with the risk of weak external demand, instability in the region, and an increasingly constrained environment for private sector activity. However, Africa's robust growth is not likely to affect the downward trend in global output because of a small share of global output. Overall, the committee believes that the fiscal gridlock in the US, the lingering Eurozone financial and economic crisis, as well as the softening of output growth in key emerging Asian economies would have serious implications for the domestic economy in the near to medium term. Specifically, any negative shock to the current high prices of crude oil would have adverse implications for fiscal revenue flows and external current account position, even though current forecasts and developments in the Middle East do not suggest the possibility of a shock in the near term. Domestic economic and financial developments. Output. The National Bureau of Statistics has revised the real gross domestic product growth for fiscal 2012 downwards to 6.61% from the earlier projection of 6.85%, indicating that the economy is encountering growth challenges not previously anticipated. The estimates revealed a real GDP growth rate of 6.48% in the third quarter of 2012, up from 6.39% in the second quarter, but lower than the 7.37% recorded in the corresponding period of 2011. The committee noted with concern the continuing decline in the contribution of the oil sector to growth in an era of strong oil price performance, which became apparent from the last half of 2011, and also the decline in the contribution of agriculture to growth since Q3 2011, despite of the beginnings of the agricultural transformation initiatives of the federal government. The relatively robust projections for 2012, despite the slowdown in the global economy, reflected the continuing favorable conditions for increased agricultural production, the impact of the banking sector reforms, and the initiatives of government to stimulate the real economy. In this regard, the committee welcomed the recent improvements in electricity generation, which have impacted positively on manufacturing activities and overall capacity utilization. The committee enjoined the federal government to sustain the efforts at electricity reform. The committee, however, observed that the recent flooding in several parts of the country, current security challenges, and corruption scandals pose serious downside risks to growth in the near to medium term. Indeed, it noted that the full impact of the widespread flooding was yet to manifest, while the cost to the economy was yet to be estimated. The committee noted the combined effects of high tariffs, floods, and drought on global wheat supplies, which have led to high prices of wheat in Nigeria. Prices. The committee noted that inflationary pressure, which moderated in the third quarter of 2012, re-emerged in October 2012. The year-on-year headline inflation inched up to 11.7% in October from 11.3% in September, while food inflation increased to 11.1% from 10.2%. core inflation continued its sequential 4-month moderation to 12.4% from 13.1% in September, while food inflation remained hawkish, thus creating mixed. While the risk to food inflation remained high, thus creating mixed price signals. The major drivers of inflation during the period include food and housing, water, electricity, gas, and other fuels. The pickup in food inflation contradicted recent trends and may not be unconnected with the effects of the floods on farmlands, the impact of which pose an upside risk to inflation in the near term, coupled with continued imported food inflation. Although core inflation continued its moderation, the committee considered the current levels still to be elevated, driven largely by processed foods at 3.7%, housing, water, electricity, gas, and other fuels 4.2%, clothing and footwear 1.4%, transport 1.1%, furnishing, household equipment, and housing maintenance 0.7%, and education 0.6%. However, the major drivers of core inflation remain outside the scope. The major drivers of food inflation remain outside the scope of monetary policy alone, which has helped us in addressing the structural components. In the meantime, fuel prices have risen generally above the official pump price, even without the total removal of fuel subsidy. Monetary, credit, and financial market developments. Broad money grew by 8.23% in October over the level at end December, which annualizes to 9.87%. Aggregate domestic credit declined by 3.48% in October 2012. The decline in credit to government between June and October implies that the federal government is increasingly becoming a net creditor to the banking system, which perhaps reflects the impact of better fiscal management, including the introduction of the Treasury single account. Interest rates in all segments of money market moderated between September 19th and October 30, 2012, reflecting increased liquidity in the banking system induced by the release of statutory revenue to sub-national governments, the repayments of matured CBN bills, and absence of repo operations during the review period. The interbank call and OBB rates, which opened at 16.77 and 16.4 on September 19, 2012, closed at 12.03 and 11.7% respectively on October 30, 2012. The average interbank and OBB rates for the period were 11.68 and 11.38% respectively. The foregoing notwithstanding, the committee was concerned that the moderation in money market rates was only beneficial to prime customers who enjoyed a fair degree of reduction in rates on their loan facilities. The average prime lending rate declined from 16.96% in July to 16.48% in October. Average maximum lending rates, however, which is the rate at which SMEs borrow, increased from 23.45% to 24.65% during the period, while the weighted average savings and term deposit rate stabilized at 5.3% during the period. The committee therefore enjoined the bank to fast-track the financial inclusion strategy to ensure the effectiveness of the transmission mechanism of monetary policy with a view to improving the financial intermediation process and reducing the high spread between deposit and lending rates in the banking industry. The committee observed that the rally in the Nigerian capital market continued as equities market indicators trended upward in the review period. The all-share index increased by 22.37% from 21,599.57 to 26,430.92 between June 29 and October 31, 2012. Market capitalization also increased by 22.15% from 6.9 trillion naira to 8.42 trillion naira during the same period. The positive performance of the ASI and MC were due to strong investor confidence following improved second quarter financial performance of blue chip companies, as well as excellent results from a reinvigorated banking industry. External sector developments. At the wholesale Dutch auction system, the exchange rate during the review period opened at 157.36 naira to the dollar on August 30, 2012, and closed at 157.3 on October 31, 2012, representing an appreciation of 0.06 of 6 kobo or 0.04%. The average WDAS exchange rate during the period was 157.33. At the BDC segment of the foreign exchange market, the selling rate opened at 161 naira to the dollar on August 30 and closed at 159 naira to the dollar on October 31, representing an appreciation of 2 naira or 1.24% for the period. At the interbank segment, the selling rate opened at 158.1 naira to the dollar on August 30 and closed at 157 naira 0.06 to the dollar on October 31, representing an appreciation of 1.04 kobo or 0.66%. The appreciation recorded in all segments of the market could be traced to the combined effects of tight monetary conditions, improved supply of foreign exchange to the market by all companies, increased inflows from portfolio investors, and the policy that barred the DMBs from accessing the CBN lending window and WDAS simultaneously. The committee noted with satisfaction that the premium between the rates at WDAS and Interbank and between WDAS and BDCs narrowed towards the end of the review period from 0.74 naira to the dollar and 3.64 naira to the dollar to 0.03 naira to the dollar and 1.68 naira to the dollar respectively, suggesting the need to sustain and further complement existing measures to discourage speculative activities in the foreign exchange market. In general, the committee noted that the decisions taken at previous MPC meetings are yielding the desired results. The committee expressed satisfaction with the significant accretion to external reserves, which stood at $45.68 billion as at November 15, 2012, representing an increase of $10.27 billion, or about 29%, from the level of $35.41 billion as at end June 2012. Compared to the year end of 2011, external reserves had increased by $13.04 billion, or 39.95%, over the level of $32.64 billion. The increase in the foreign reserves level was driven mainly by proceeds from crude oil and gas sales and crude oil-related taxes, as well as reduced funding of WDAS due to increased inflow of foreign direct investment. The foreign reserves level will finance over 10 months of imports. The committee urged the central bank to continue to monitor the inflow and destination of FDIs and remittances, conscious of the risk to financial stability of a rapid outflow of hot money. The committee's considerations. The committee noted that developments in the global economy characterized by general uncertainty on the back of the deceleration in global growth sustained by the fragile financial conditions, weakening labor and housing markets, and deteriorating public and private balance sheets across advanced and emerging economies have implications for the domestic economy and therefore demand careful consideration in arriving at an appropriate decision of monetary policy. The uncertainty surrounding the resolution of the fiscal cliff in the US and the downside risk created by Hurricane Sandy on US output in Q4 are also important factors to consider. The committee noted that if the fiscal cliff was not resolved quickly, it would negatively impact the already ballooning deficits and subsequently tip the economy into a recession with downside risk to all price developments. The committee noted that the lack of clear direction for the resolution of the euro area crisis will continue to signal a likely recession in the area in the near term. Developments in the domestic economy in the past 3 months highlight some new pressure points to macroeconomic stability. The committee also of the view that despite high interest rates, additional shocks to the economy emanating from devastating floods, imported inflation, and the upward adjustment of electricity tariffs continue to stoke inflationary pressure. The committee noted the conflicting price signals coming from the latest inflation numbers from the National Bureau of Statistics, with headline and inflation trending upwards, while core inflation rates continue to moderate for the 4th consecutive month. This, according to the committee, has created uncertainty as to the appropriate policy stance at this time. However, since the factors underpinning the inflationary pressures were mainly structural, a monetary response may not be appropriate. Furthermore, the committee observed that while there were compelling arguments for monetary easing at this time, based on the continuous moderation of core inflation, slowdown in GDP growth, and evidence of fiscal prudence, the short-term gains may not be sufficiently adequate to overturn the long-term implications of sending a wrong signal that the tightening cycle was permanently over. With regard to the balance sheet of the federal government, the committee was of the view that it has become imperative to shift away from looking at the size of the deficit and borrowing alone to emphasizing the quality of expenditure and decisions on the allocation of resources. The committee commended the fiscal authorities for keeping the fiscal deficit firmly in line with the 2012 budget and improving the revenue profile of the federal government by plugging several of fiscal leakages. It called on the government to significantly increase capital spending and increase its focus on improving on governance and transparency in the public service. On the oil price benchmark used in the 2013 budget, the MPC reaffirmed its support for maintaining the $75 a barrel proposed by the fiscal authorities and noted that this has become even more critical in light of evidence that output projections may have been overly optimistic. In this regard, the committee calls on the government and the National Assembly going forward to borrow from the Chilean experience with regard to setting up parameters for the preparation of the national budget to avoid the perennial rancor between the executive and the legislature on benchmark oil price. Specifically, the committee called for the setting up of an independent legal structure that will set the benchmark output and price underpinned by a long-term trajectory of output and prices by independent experts who are shielded from political interference and interests. In view of these developments, the committee was faced with three choices. One, an increase in rates in response to the uptick in headline and food inflation. Two, a reduction in rates in view of declining core inflation and GDP growth. Three, retaining current monetary policy stance in view of conflicting price signals and global uncertainties. The committee's decision. The committee considered and rejected option one as being potentially pro-cyclical, considering the structural nature of recent inflationary pressures. While acknowledging the merit of the arguments in favor of option two, it was also rejected as likely to send wrong signals of a premature termination of an appropriately tight monetary stance. The committee therefore decided by a unanimous vote to maintain the current policy stance, i.e. to maintain NPR at 12% plus or minus 200 basis points, maintain the CRR at 12% and the liquidity ratio at 30%. Thank you.
Please, questions, there are microphones. Identify yourself and the media house you represent. Keep it short, please.
CBN Africa. How concerned is the MPC about the global economic slowdown next year, given the threat of US rolling over the fiscal debt? Thank you.
I just wanted to ask about the inflation outlook for next year, if possible, and if you have an estimate for this year, the outlook inflation rate. And for the Naira, are we going to see any more changes in next year, another denomination?